Silver didn't just move, it broke. The Shanghai Futures Exchange just dropped a policy update that effectively changes the rules of the game. Starting on the last day of February, if you do not have a hedging quota, your delivery allocation is zero. Not reduced, not delayed. Zero. This is an admission of a physical shortage so extreme that they have to turn off the tap. While the Western world is sleeping, a $297 billion shift just hit the market, and almost nobody is connecting the dots. Here's the reality of the situation. We are witnessing financial warfare, but it's not being fought with tanks. It's being fought with ounces. Let's look at the hard data. Right now, the price of silver in the West is trading around $85, $90, but in Shanghai, it is trading over $92. That is a $7 premium. Think about that for a second. If you could buy a burger for $5,000 on one side of the street and sell it for $10 on the other side, you would do it all day long. In finance, we call that arbitrage. Usually, the market fixes this gap instantly. Traders buy the cheap stuff and sell the expensive stuff until the prices match. But that isn't happening here. The gap remains. Why? Because the metal isn't moving fast enough. The physical silver is stuck, or worse, it is gone. This week alone, silver surged 8% in just 12 hours. That move added nearly $300 billion to the market cap. But while the price is skyrocketing, the exchange is cracking down. The Shanghai Exchange suspended 20 different account groups in a single week. Imagine a casino. Usually they want you to play, but suddenly they start kicking out the high rollers and locking the doors. That tells you the casino is out of money. In this case, the exchange is running out of metal. They are kicking people out to protect what little inventory they have left. This is unprecedented. Article 16 of the exchange regulations allows this, but we rarely see it used this aggressively. Now let's look at the western side, the conchs. Yesterday, 861,000 ounces of silver left the vault in a single day. It just walked out the door. We are seeing March contracts being closed or rolled forward at a frantic pace. Here's the math that should scare you. Right now, the open interest, which is just a fancy term for paper bets on silver, is about 340 million ounces. These are people who think they own silver, but the registered silver is actually sitting in the vault. It's only 101 million ounces. That is a 4:1 ratio. Imagine 4 people holding a claim ticket for the same car at a valet stand. Only one person is driving home. The other 3 are going to be left standing on the curb holding a piece of paper. This is what we call a paper claim versus physical reality. And the gap between those two things is closing fast. Even the mainstream media is starting to accidentally tell the truth. Bloomberg just put out a report on the Lunar New Year. They talked about retail clients buying small bars and coins, standard holiday stuff. But buried deep in the middle of the story, they dropped a bombshell. They admitted that supply constraints in silver are raising concerns. Read that again. Supply constraints, not from a conspiracy blog, not from a YouTube comment from Bloomberg. They are bearing the lead, but the data is there. David Jensen, a top analyst in this space, just confirmed this. He noted that vaults are depleting globally. It's not just New York. It's not just London. It is everywhere. Lease rates are skyrocketing, which is the market's way of screaming that there is no metal available to borrow. We have had decades of overconsumption and underproduction. We use more silver than we dig out of the ground. For years, we filled that gap with stockpiles. But now the stockpiles are running on fumes. The price volatility we are seeing now is just the tremor before the earthquake. The supply shock is here, and the math says prices have to go higher just to force new metal into the market. This isn't just about supply and demand anymore. It is a geopolitical chess game, and the Western media is refusing to cover the board. Here is the move that matters. China's share of U.S. imports just hit a 26-year low. For 5 years straight, they have been cutting the cord. Think of it like a messy divorce. The United States thinks it can punish China with tariffs and taxes. But that assumes China still needs the U.S. to survive. The data says they don't. They have already moved on. They rerouted their supply chains. And while they were leaving, they started packing the most valuable items in the house. China is now hoarding strategic metals. They are putting export controls on the things the world needs to function. This is why the Shanghai Premium exists. Right now, silver in the East costs way more than silver in the West. That premium is a warning siren. It is the market telling you that the physical metal is divorcing the paper contracts. In New York, you trade a digital receipt. In Shanghai, you trade the actual metal. And right now, the metal costs more. Let's look at the hunger for silver versus gold. Economically, for every 100 ounces of gold available, there is roughly 1 ounce of silver. It is rare, but we treat it like it is common. We don't just put silver in a safe. We burn it. We use it in solar panels. We put it in electric vehicles. We use it to build the AI data centers that everyone is obsessed with. Gold sits in a vault. Silver gets used up. It vanishes. We are consuming it faster than miners can dig it out of the ground. People aren't switching to silver just because gold is too expensive. They are swapping because the return on investment for silver is crushing gold. The price on your screen in New York is becoming fiction. The real price is what happens when a big player walks up to the exchange window and says, "Give me my metal." That is when the system breaks. That is why Shanghai is restricting deliveries. But here is where it gets confusing. If silver is the obvious play, why are the big banks sending mixed signals? This is the billion-dollar question. You have Bank of America waving a red flag. They just added U.S. material stocks to their bubble list. They are warning that AI and innovation are creating unstable markets. They are practically screaming sell. But in the same week, Wells Fargo, another massive bank, raises their gold target to over $6,000. They are predicting a 20% upside. They called the recent price drop a healthy correction and a buying opportunity. So who's lying? You have two of the biggest financial institutions on the planet looking at the same data and giving you opposite advice. One says bubble, one says breakout. I'm going to tell you exactly how to read this, but first, you have to understand what they are actually measuring. If you zoom out, the answer is shocking. Look at the S&P 500 versus gold. The S&P 500 represents the greatest companies in America. Apple, Microsoft, Amazon, the smartest entrepreneurs, the best technology, the highest productivity in human history. Now look at gold. It is a rock. It sits in a dark room and does nothing. It has no earnings. It has no employees. That has no innovation. Yet, for the last 25 years, that rock has outperformed the S&P 500. The stock market is down 60% relative to gold over the last 2 decades. Think about how insane that is. All that work, all that tech, and it couldn't beat a rock. This tells you the problem isn't the assets. The problem is the measuring stick. The dollar is breaking. Maybe the bubble isn't in gold or silver. Maybe the bubble is in paper assets that are priced in a currency that is losing value every single day. Now, I have to be fair. I have to give you the other side of the argument because blind optimism will get you broke. There is a bearish case here. Silver is volatile. It moves fast. Recently, we saw daily moves of 4% to 6%. That is violent. When lease rates spike like they are now, it could just be a temporary glitch. It might be a short-term squeeze that fixes itself next week. The conchs may find enough silver to meet the March deliveries. We have seen doomsday predictions before that turned out to be nothing. The Shanghai premium is high, but we have seen it higher. Prices can crash. Momentum cuts both ways. Just because the fundamentals say up doesn't mean the price won't go down first. Markets can stay irrational longer than you can stay solvent. But ask yourself, do you trust the paper promise or do you trust the physical shortage? The banks are confused. The media is quiet, but the metal is moving east. Let's be real, this is financial warfare. I'm not giving you advice. I am giving you the battle plan. There's a very real scenario where the paper market continues to lie to us. They could suppress the price for months, maybe even years. We know they do it. JP Morgan paid $920 million to settle charges for manipulating precious metals. That is a fact. It is documented in court records. They admitted it. But here is the ugly truth about that settlement. It didn't stop them. They paid the fine, which was basically pocket change to them, and they went right back to the same desks to make the same trades. It is just the cost of doing business. It is like a speeding ticket for a billionaire. They don't care. So if you are sitting there waiting for justice or waiting for the regulators to step in and fix the price, you are going to be waiting a very long time. The paper market has tools to stay irrational longer than you can stay solvent. But here is the catch. And this is the part that changes everything. You can manipulate a paper price forever. You can print infinite contracts. You can create digital derivatives out of thin air, but you cannot print metal. You cannot print silver. Eventually, someone stands up and asks for the physical bar. And when that happens, the game ends. That is the wall we are hitting right now. Starting on the last day of February, the Shanghai Exchange is restricting deliveries. Why? Because they are running out. We are seeing vault depletion all over the world. We are seeing 20 account suspensions in a single week. We are seeing Bloomberg admit on live TV that supply is tight. These aren't opinions. These are cracks in the dam. Daniel Oliver, a major capital manager, just put a target on gold, $2,500. His logic is simple. The dollar is trapped. The government has 2 choices. Option A, they default on the debt. Option B, they print trillions of dollars to buy the debt. Both options kill the dollar. This isn't a conspiracy theory from a guy in a basement. This is institutional money looking at the math and realizing there is no exit. If gold is the safety net in this scenario, silver is the rocket fuel. Silver has a dual engine. It has the monetary demand because the dollar is dying. But it also has industrial demand. Solar panels need it. Electric cars need it. AI data centers need it. We are burning through it. That is why silver jumped 35% in 5 days. It is a coiled spring. Look at the scoreboard right now. Conchs vault 101 million ounces of real silver. Paper claims 340 million ounces of fake silver. That is a 4.1 ratio. 3 people are going to lose their chairs when the music stops. We have seen a pattern for years. Asian markets buy gold and silver overnight, pushing the price up. Then New York opens in the morning and dumps paper contracts to smash the price down. It happens like clockwork. But that mechanism is breaking. The price in Shanghai is staying high. The buyers in the East don't care what the price on the screen in New York says. They are paying a premium because they want the metal in their hand, not a receipt in their email. This is the signal. I want you to verify this. Do not trust me. Do not trust the news. Go to the source. Check the Shanghai Futures Exchange announcement. It is official policy. Check the COMEX daily reports. The numbers are public. Read the Bloomberg report on Hong Kong demand. The people who are lazy are waiting for the guy on CNBC to tell them it's okay to buy. By the time he tells you, the price will be double. The people who do the work, they are already positioned. They see the 20 suspensions. They see the empty vaults. They know what is coming. The warning isn't coming next month. The warning is right here, staring you in the face. The choice is yours. You can be the person who reads the headline and scrolls past. Or you can be the person who looks at the numbers. The numbers don't lie. The hype is noise, but the math is screaming. The Shanghai Exchange just showed its hand. They are desperate. If you wait for the news anchor to tell you it's time to panic, the opportunity is already gone. The biggest wealth transfers in history happen while the majority is still sleeping. But there is one piece of the puzzle we haven't touched yet. There's a specific accounting trick the big banks use to make empty vaults look full. It is the only reason the price hasn't doubled overnight. I explain exactly how the shadow ledger works in this video. It reveals the paper trail they are trying to hide. Click here. Watch it.